Okay, this is part two of our tax equity exercise, a little test that you might get for an interview, a ridiculous kind of thing. That would be, and um, I'm trying to keep it structured, and I'm trying to put signposts because my friends at Red Cliff, whatever they call it, who just fired me. Said, "Oh, you didn't have enough signposts to tell people where you're going and what you're doing." So we're going to do a time-based flip. We've got these cash flows and these taxes, and now we figure out who gets what, and then at the end we put some leverage on it, which is almost the kind of easiest thing to do. This leverage, okay, and I have to tell you, what you do in a test situation like this when you don't know something. So this seems to be a test where they're kind of having a little bit of presumption about a little presumption about how much you know. And number one, I just didn't get that they didn't tell you how much tax equity is going in. I'm going to make that one. This is really times ITC, and this they didn't tell you, is this both or and. So is it, if the it almost, if you're logical about it, it would really have to be the you'd flip it at the, if you got a yield based flip. Well, I don't know if it would be the earlier or the later. I was just going to say it would be the later of the two. You want to make sure that this 7% is earned, but if this 7% is earned before the 7 years, then you might want to flip it earlier. So I'm going to make a flip both ways. And then we can kind of say, well, we can put them both in, and then you can say, I'm going to apply the time based or whichever I'm going to apply, maybe one earlier or the next one earlier. We'll keep them all flexible. And I'm sorry, I just don't know this. I have to ask somebody this, and I just admit these days when I don't know something, I just admit it and say, okay, I got to make an assumption about it. No, I just admit it, and then I ask people, what the heck do you do? Sorry, and somebody will maybe even write in a comment that that's what you have to do and help me out there. Okay. And so this 99% is percent of income. It's not percent of depreciation or anything like that. It's percent of income. And this yield based flip is based on after tax income that the tax equity gets. And that, once you have this flip period defined, once you have that flip period defined from the yield, okay, uh, 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 then you switch. You just switch all these ratios around. So you just need to know when this occurs. If it's just in year seven, it's really, really easy. But if it's on a yield based flip, it's a little trickier. So I'm going to do the yield based flip first, and then we'll do the time based flip. But having said that, I'm going to be a little contradictory. So we'll put a flag for time based flip. Okay, and oh no. Okay, why? Oh no, why in the heck did this happen? I need to understand that. Oh shoot, I got to do something about this. Nobody's going to pay zero amount for my little tool anymore. Oh God, that's okay. Maybe Redcliffe was right. Okay. All right. And now, who is Redcliffe? It's just probably some asshole trying to make money off of old people like me to teach these classes. So I'm going to put here the input is going to be our 7 years, and even here we could put this as years, right? And this is years. Okay. Oh, that's pretty cool. I never thought of that before. And we could maybe, I'm not going to copy it to the other sheets right now, because then I'd have to recolor them and all that. So we can just say, well, this thing up here, this year has to be less than or equal to the 7. That's our time-based flip. Okay, and then shift alt F, which is this man named Ali at, I can't tell you, he was from New York, I can say that. He had this way where he does copy paste specialist, multiply, puts a 1 there and does that, and that's exactly what this does. I like it. Okay, you don't give a fuck. Now let's put for the yield based flip. Here's what we do. We I guess, let's transfer some variables. And the thing, the yield-based flip, I'm trying to get it out of my mouth, it's the after-tax cash flow. That's what we use as the basis for computing our flip, because this is all about the tax investor. Okay, and now I might get in a little bit of trouble. I don't care. That's good that I'm kind of struggling here. Okay, because the actual allocations of the cash flow will be based on no, I'm doing it wrong. I got too ahead of myself. I'm really sorry. Let's put the EBITDA here, and let's put the capex here. Okay, and I'm really surprised in a way that they didn't just do a yield a time-based flip for a test. So this is actually a little more interesting, but a little more difficult too. So we'll get and that green, by the way, that green means it comes from another sheet, and we get our capex. Okay, now if you're from outside of the U.S. like I am, but I don't sound like it, well, whatever. That's, who cares? You don't care about this crap. You really, really don't. You could please, unless you have some wacko curiosity about something like this, turn the video off. Now, the way to, well, with one exception, this yield-based flip is tiny bit interesting because it's like allocating equity cash flows. And if we want to do that, we can put the tax investor cash flow before flip. Okay, and we also need to get two things. We also need to get the ITC, okay, because the tax investor, this IRR that you're going to compute for the tax investor is going to be, where did I put the ITC? ITC amount here. This, did I? Yes, this is not the total. I'm getting a tiny bit confused. And then we can put the total depreciation. Okay, so we need to grab those from another sheet. Okay. And here, okay, there we go. And if we have the tax investor before the flip, then uh, uh, they get some cash flow and they get some income. And actually, before we do this, I am sorry. This is, ooh, then maybe they're right, Mr. Radcliffe, because I didn't do this. Let's put let's do the time. I'm gonna just change everything. I'm gonna do the time-based flip. Okay. Okay. And well, now I'm a little nervous. For the time-based flip, let's put the tax investor pre flip and the tax investor post flip. I'm flustered. After before tax investor pre flip income and income, and then let's put the change this to the okay, I'm not going to do a copy. I'm going to change this to the sponsor. This was really an idiocy of mine to suggest that we would do this, to suggest that we would do this uh, 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 with the more complicated method first. Okay, and this is a %2. So let's get our pre-flip for the tax investor was the income, we get 99%. And after the post flip, we get 1%. And for the and this was oh, shit. Okay, that we can do this. This is 1 minus the 99%, and this is 1 minus the 1%. And then we do the whole thing again. Okay, we copy this all the way down here, and we put the instead of income, we put cash flow. And we put up here cash flow. Okay, and there's going to be something that's that I understand, and I'm just going to work it out. And if I get this a little bit wrong, I don't know what I'm going to do. You didn't pay for this, so I'm going to give you a caveat and say this is how I would make the allocations myself. So the pre-flip cash flow the investor gets, I should have thought through this, and this is all for the tax equity, and after that they get 5%. Now the reason for that is if you think about teenagers, and you can have a deduction for teenagers. And if you think, okay, why can't I just, as a poor person, I am poor, you guys are richer than me, or you will be, and why can't, if I had a teenager, my children are older, if I had a teenager, why can't I sell the deduction, my teenager, why can't I give that to you? And then you can pay me, and the deduction for that teenager will be worth more to you than it will be to me, because you're in a higher tax bracket. So why can't we just set up some transactions? Why can't we have some investment bankers figure out all that stuff for us? Well, if you did that, everybody would sell their teenagers, and the rich would own all the teenagers. And the IRS says, okay, if you that's kind of what we're doing. But the IRS says, no, 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 no. That's the IRS is the U.S. tax authority. No, you cannot do that unless you take risk. So this 5% shows that you're taking risk in the project. If you didn't take risk, and what actually happens is you sell it and you get out of it, and a whole lot of that. Okay, so we have that now. I put all that in, and why don't we just put with all of this? You know, I'm gonna. Why don't we do it like this? Okay, and like this. Okay, and then we don't need all these lines. Okay, I think that's a reasonable way to do it. And we've got to change some of the title, and then this is tax investor income share. Okay, and I don't mind that I did that and left the video on, and I'm not going to say, oh, I should have. I'm wasting everybody's time, and somebody's going to give me a bad comment, and I'm going to be crushed. Oh, okay, so what? And then we put our sponsor. Okay, and so now if it's a time-based flip, okay, all we have to do is and you can see that I can't multitask. I cannot multitask. You can see that. So if we have the flag for a time-based flip, we just put an if it's the true, that's one is true. If it's true, then we take this one. Otherwise, we take this one, right? But why don't we do this a little more elegantly and press the F4 a couple of times and the F4 here and oops, I need another one there and this F4 a few times. Shift Control P, Shift Control R. So now we're going 99 to 1. Okay, and then we do, I think, can I copy this? Please let me copy. There we go. Or we could have actually subtracted one, couldn't we have? Okay, sorry about that, but whatever. Okay, and this is another thing, you know, for me, it's a big theme in modeling is that you try things different ways and you figure out what works, and then you use that. Okay, and then we can put up here our income, and our that's also put our ITC, and the income is the EBITDA minus the depreciation. Okay, and the ITC is the ITC. Okay, and if you didn't do it in this order, can you imagine what a mess it will be? And the cash flow is the EBITDA. Okay, and we're ready to start kind of doing a little bit of our allocation. Okay, now let's put let's start in this case. Let's start with the tax investor. Okay, and let's put the cash flow that they get. And this is the big problem. Oh, do I have to put my dollar signs? Okay. Oh no. Okay. And here's our cash flow. Our cash flow that the tax investor gets is this one, maybe I have it a little bit out of order, but whatever. Okay, they got that cash flow. Okay, and then so that's just EBITDA multiplied by their percentage, and the income they get is the income up here, which is negative. You love the negative income, and they get 99% of that negative income, and that's exactly what they want. But they don't want this stuff in year 7. They don't want this stuff here. I don't know why we have a 7-year period. Maybe it's common. And then of the ITC, they get they also get the 99% of the ITC, and a lot of this is all about understanding what is allocated on an income basis and a cash flow basis. Now let's put let's put in uh, the contribution, the investment. Okay, and we'll make that $1. And this time, I'm going to go and show the whatever the. And then we'll. This is $1 too, but I'm gonna this no, this is a percentage, and we'll get the contribution ratio. No, it's not a percent. It's kind of it's like a times. How's that? We'll get that contribution ratio that they didn't give us, which is really what I didn't understand. And even while I'm not while I'm not understanding that, I'm going to copy that to the page, and we'll put it here. And then what we can do, so this, and then we're going to use as a basis for that the investment tax credit itself, not the 99% of it, this one. Okay, and okay, so they're going to invest. I will put if it's we can use this one, or we can use the operating flag. If it's the operating flag, we'll put 0. Otherwise, we'll take. You can put another comma there, I guess, right? We'll take this contribution ratio multiplied by this, but we've got to press the F4 on this one and F4. We always press the F4 on when you take them from that column. Okay, so that's how much they're investing. Now, if you would like to see the cash flow they receive, you could also say the net. Let's put the net cash flow after tax. Okay, and I don't know, maybe when they put this 7%, they didn't really mean it's a yield-based flip. Did they even say what the 7% was? Was that just like a target tax? They called it the flip IRR. So they called it. It implies a real yield-based flip. Okay, if they're going to get this, they're going to get the cash flow, and then they're going to get the taxes, and then they're going to get the ITC. How's that? We'll put them all, and we'll put the net cash flow, and then we'll see what the IRR is pre-flip. Or no, this is just the total IRR. Tax investor IRR. Now, this assumes a really radical assumption here is that we have not gone through the inside basis, outside basis, and we've not work through we've not worked through the constraints and the one of these accounting firms, for some reason they call it stranded taxes, which is kind of a wacko thing to say, but it kind of it's maybe it's okay. So for the taxes, uh, okay, whoops, this is just a title. Okay, where are we at? This is the cash flow, and this is going to be a percent, and let's get our tax rate again from the input page, and that's that. And you notice the good news is that we're kind of we're getting there a little. What happened to why did the thing start when it starts to be not charging? You know, like my computers are really old, and I don't have much battery power left on all these things because the batteries degrade a lot. And then the ITC is again, this is just, we don't need this. This is going to be what we get back. Okay, and then we have the investment. Of course, I didn't put that. And then we'll put that. And we'll just work through this logically. Now that you could have said, put that as a negative. Oh, no, you got to put that as a negative. Screw it. Just think through, okay, let's put less investment here. If you're really going to get uptight, my friend from Ukraine, who's a wonderful man from Mariupol, he didn't get a job at PwC because I didn't tell him to put a negative there. It was just so criminal. Oh my God. So we take this one minus the minus of the taxes plus the investment tax credit minus the capex. We got to just think through it a little bit. And they've made this little negative investment, and they get an enormous return, I think, on this investment. And that's the kind of classic thing where they hate to even measure the return. Okay, and we put equal IRR, and we get all of that. Okay, and oh shit, we get a really, really big IRR. Okay, that's why so if they put a lot more investment in there, we can push this down. And if we push it down here, we can kind of figure out where it would go until they flip it. Okay? How about we'll leave it like that? And then we can even copy this and put this on the output page here. Okay? And maybe I'll put it here. And we can kind of see what parameters we have to do. I don't know if this was kind of meant to be part of the assignment or not. We can take it from here, and of course we can change it around. Okay, and then we can we've got the overall. While I'm at it here, we've got the overall IRR on the whole project. And then I would say, let's put a hypothetical with full tax deduction use. We just make up a name. That's what you do in finance, in case anybody doesn't know that. Okay, you make a fancier name than that with springing use of the reserve accounts or something like that. Okay, and these are not affected by this contribution ratio because we haven't done it. And then we could put after tax, let's put time flip here. Okay, so we can put all of this time-based flip in this one. Okay, we've got this one. Now, if we do the sponsor, and this is unlevered still for the sponsor, we can compute both the free pre-tax and the after-tax. Now with the after-tax, we'd have to make an assumption about how they're paying the tax, if they've got a net operating loss carry forward or not. So that gets a little bit dicey, and maybe this is not exactly what they wanted, but okay, we're just going to keep going. So now let's put, I was just struggling with this, and I think we should put this, okay, so let's do net cash, and then we put tax investor time flip. Okay, and then we can put and for the tax investor, you wouldn't compute a pre-tax thing really, and then you can put net cash flow, and let's put for the sponsor. Okay, now the first thing we can do here is let's put the investment, total investment. Okay, and we can put a $sign here. And if the total investment, now we have the total capital expenditures that we need to get paid for. We need to pay for that, minus we'll put the investment made by the tax investor. Okay. And it's kind of interesting, really, that in these assignments, and then we can put the cash flow, and the cash flow is, I hope, did I compute the total cash flow? No. Well, let's just lay it out so we can see. Let's put the total EBITDA less the what am I saying? Less the come on, the tax investor cash. Okay, and that gives the other, we've got the sponsor cash. Okay, and really how this yield-based flip will work together with, I need to see a term sheet really. I have not, I don't know, I don't have one. I have some term sheets, but one that has both the time-based flip and the yield-based flip. So the EBITDA minus the what they get. Okay, that's it. Whoops, I meant to. I should read what I'm putting in. So there's the total EBITDA. There's the EBITDA that's received by the tax investor. And so the difference is what the sponsor gets. And that's what you're going to finance. Now, if you, let's do something silly here. You know, I should be putting the shift control V here, shouldn't I? Okay. You notice how I go all the way to the end, and I do that on purpose because some auditor got me and said, "Oh, you didn't sum to the end," and I wasted a week on this crap. Okay, so that's that you get more, and you might want to just put a insert, and this is really this issue for the banks is what happens. Here's the, let's start here. Okay. Ooh, uh-oh. This is looking funny. I'm glad we did this. Why does that? No, that graph is. Let's. This graph didn't work here. That looked like crap. What should I do here? If I put a spark line and let's just make it a line. Why does it go up like that? I guess it really didn't work, did it? Okay. I'm gonna I'm I'm gonna do it like this. Let's just make a graph of this F11 for just a minute. So it wasn't nearly that dramatic, and what's happening is we get to year 7 and we get a flip, and then it goes down, and then we get this merchant cash flow. I'm sorry about that. And this is what we're going to leverage. And if you change this flip date, then the cash flow becomes a lot more risky for uh, uh, the debt investor. And it looks like what I'm going to have to do is make a third part of this for just the financing. Okay. So we got the sponsor cash, and then we can put the net cash flow pre-tax, and we can, when we do that, let's just take this one, the sponsor cash minus the minus the amount they initially invest. So in a way, doing this stuff on an annual basis, in a way, is uh, 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 is you know the I'm trying to get some words out, but it makes things clearer. So we can kind of start filling this in. Now it's tough to compare a pre-tax and an after-tax return, but this is kind of what often gets done because these sponsors might be in a position where they've got a whole bunch of extra deductions, and they're in a net operating loss position. So we could, if we put a higher amount of whoops, that investor cash flow got too low, but you can change this around and kind of figure out uh, uh, who's who, who's getting what, and try to come up with a structure that works. Okay, and this is our time based. Okay, uh, and now let's do this after tax, assuming uh, 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 let's make this the income. So on the income, again, you get the. I think this time we don't really have to do it in the same kind of way. We can just take the oh no, oh god. Let's take the let's put the total income, and then put the income to tax investor, and then the income to the sponsor. And you can see all we're doing here is just allocating. So the total income is the which I guess I didn't do it here. Yeah, I put the total income. No, that's the income to the tax investor. I hope it is. Just a minute. I've got to make sure that I did that correctly. So the income is the EBITDA minus the depreciation. Okay, and I put that's negative 27. Okay, and that's this time income is 24. Where was just a minute? 24. Oh, I already did it up here. Okay, sorry about that. Okay, and then we can take away the income that we gave to the tax investor, and they loved when they were getting the negative income. Okay, and then so the income to the sponsor is this income minus this, and we still get some negative income, and we also get so taxes to the sponsor. And whoops, and I might have to pause just a minute. Okay, during the phone call I made, I added a couple extra lines, just filled them in. And we get the investment, we get the taxes. So we have the taxes, the investment tax credit by the sponsor, with just the remaining, and the investment by the sponsor. So they get this cash flow. They get the benefit of these taxes, but then have to pay much higher taxes later. And then they get the ITC, and they have to pay the investment. So we pay net. Now this assumes that the sponsor is totally taxable and can use these tax benefits. We could put in a NOL, but since these tax things are small, let's leave it like this. So let's put net cash flow. Okay, they didn't, the assignment didn't ask anything about NOLs, so why screw it. So we get the cash flow they get plus the minus the taxes. I did put a minus on the taxes. Plus the investment tax credit minus the final after tax cash flow, and then we can put the sponsor after tax cash flow, and let's put that as a percentage, or instead of after tax IR. I'm kind of starting to lose it, I think, here. Just not permanently. I still want to go. If I ever had to quit doing this, I couldn't take it. Okay, so they pay a little bit of taxes, and then we can. So I suppose we can put that as the output. Uh, um, now we just have to put in our leverage and our gearing. Okay, but before that, we should talk about the yield-based flip. And I'm going to try to structure the yield-based flip. And I suppose on this one, and why don't we put the capex here? I suppose we can get the capex for this in this one, right? Okay, and then we can see, well, who's who's investing what? Okay, we've got sources and uses, and the tax equity investment we have from this page. Okay, and we put, that's where we kind of put our our amount in. Okay, and then we don't really, we could have just put the difference, but why don't we go ahead and get the amount of contribution by the by the sponsor. Okay, and then we're going to see, well, that sponsor is going to put some equity and some back leverage, and that's we're going to try to, if, as long as, and this is all going to be based on a pre-tax cash flow, so as long as this is greater than the 4% rate, which would be a low rate these days, I understand, then the leverage is going to be higher, and I suppose we can do the taxes and assume that the interest is deductible and all that, but a lot of this will be computed on this. So we only have one to do, but we use the time-based flip. So let's just lay out kind of a yield-based flip. Okay. And the idea here is that the the cash flow and the income percentages, they depend on the cash flow. So let's start with the total cash flow, and not with the, before we allocate it. Now what we're going to do is first make an allocation to the um, the sponsor, the tax investor. And then once they've hit that flip, then you can figure out who gets the rest and all that. Okay, so and so we don't those flip percentages we don't we use differently. I'm sorry to not being able to get this out. And then we can put the income. And the problem here is for the tax investor. So let's get this total cash flow again, just because this is really because of me. The total cash flow is here. That's the EBITDA, and the total income is up here. Okay, and then we put in the okay, then once we have this, and then let's put in the ITC too. Okay, because that's going to be our next one, and we'll put in the total ITC. Okay, and we can put the tax investor in cash pre-flip. So I had to write it down here, and I'm gonna not worry about all my silly little unit things right now. The tax investor pre-flip, for the income they get 20%, and the tax investor income pre-flip, I might have just said income when I meant cash, is the 99%. Okay, and what we're going to do is keep track of this until that tax investor can make the flip rate. Okay, so so they get out of this cash, they get this, and out of the income they get this, and the tax investor ITC is, we're going to use the 99% again and give them 99% of the ITC. That's kind of the big deal. Okay, and then we can copy these across. Oh, I didn't copy these. Okay, shoo. And then we can say, well, what's the after tax? What's the contribution and after tax cash flow? You would have to do this on an after tax basis. So we're going to go up and get this contribution by the tax equity, which I put in as 1.5 times the ITC, or I suppose you could have just put it as an input. Okay, and our after tax cash flow, just like we did before, maybe that was good that we did it like that, is the after-tax cash flow minus the taxes, minus the minus, plus the ITC minus this. Okay, and I'm not going to compute this time. I'm not going to compute the IRR. Instead of that, I'm going to call this a flip, a yield-based flip tracking account. And the way I try to explain this, and if you're in banking a little bit, imagine a non payment in kind subordinated debt where you accrue interest but you don't pay it, but you get paid by a cash sweep. So you get the you get the blah blah blah. You get the cash, and you accrue the interest, and you eventually pay down the interest and pay off the debt by accruing the interest and taking that cash sweep, and you go around, you keep going on and on and on until the IRR just hits that accrual rate. That was not a great way of saying it, but what I'd put is add the cost of capital. And I don't know if I'm allowed to say this, but GE taught me this, GE Capital, years ago when they were doing this. So we accrue at the, and you can of course do this on a quarterly basis or anything else. So where's our, we're accruing, it's like we're accruing interest at 7%. So how about I'll call that accrued cost of capital. And then you put, it's like less the sweep, which is less the cash received. And then we put below that the closing balance. And here's the trick. Well, and sorry, we got to add the investment. That's like the debt issued. Okay, and that investment is up here. That's our how much we contribute. So the closing balance is the opening plus the amount we accrue minus the cash we received plus the investment. We start with that. And then the opening balance, as usual, is the closing balance of the last period. And we take that opening balance and we keep track of, it's like keeping track of an interest on that, okay? And then we see how much cash we get. And the cash we get is the, did I do this wrong? I'm sorry. Is this times the tax rate? I didn't put the tax rate in here. Sorry about that. Okay, that was really bad. Maybe that was I was going to quickly, you know, Napoleon saying, and I multiply that by the 21%. Okay, and so our the cash we actually get to compute this after-tax cash flow is this minus the negative of this, or this minus this plus this. So the cash we received is this minus this, which is negative, plus that. Okay. And, yes, that's okay. Now, if we keep going around and around on this, okay, this balance got paid really a lot by this cash we got. Okay, I could have put this up higher. And then eventually we get to this negative amount. And what we do is as soon as we hit that negative amount here, we stop it. And you change this account from this, you put a minimum of this thing or the opening balance plus the accrued amount. Now that's really tricky to do. But what it does is it limits this. I hope. Oh no. Oh shit. No, it didn't. What did I just do? Minimum. So I've got to pause. I've got to pause. Now the way I did this, okay, I put the minimum. I don't know if I believe I left that off here. Where did I put the minimum here? I put a maximum and a minimum. So this is a very messy formula. And I made sure maximum made sure that if it's negative, you don't count this in this pre-flip cash flow. So now let's just show you how this works. If I put a small amount in, you notice that the IRR you're getting on this cash flow is exactly the target IRR. So if you put a contribution ratio of this in, and then the flip occurs almost immediately. But if you put a too high of a ITC contribution in here, eventually you could never get to the flip. Okay, so I guess, we can do this. Now, here's what was just kind of concerning me. If we have a time-based flip that goes to 7 years, but if the yield-based flip is 7%, you can say, okay, then we're flipping this in year 3. If we go here, we're going to flip it in 1, 2, 3, 4, 5, whatever, not in the 7 years, okay? And then we have to be very careful what we do afterwards, just mathematically. But this method of keeping a tracking account can allow you to see when the flip occurs. And so I'm just going to compute the IRR based on a time-based flip, and then we can kind of decide whether we take which one we take, and I'm going to leave that. Okay, so if we have this is our yield-based flip, and this is in general how it works, and I'm really, really sorry I hate these formulas like this. And I even cheated. I put a different one here. Can I copy this back here? No, I can't. I needed to move this up, but this is a video. You can screw on with this yourself. So now we can see up here, now we have this problem of this intermediate period here where the cash flow we're receiving, we're receiving 20%, but we're just receiving not all of it. We're just receiving it for a portion of the period. And I remember I did this once where you take away the cash first. So you can do this a couple of different ways. And perhaps I haven't done it for so long. We could get more elegant about it. But for right now, I'm going to leave it. Okay. And then I'm going to put investor. Not the tax investor, pre-flip cash percent. How's that? So we can take the amount of let's take the amount of cash we're receiving divided by, I really don't care about this first period, but divided by the this taxable income. How's that? Forget this first one, okay? And just a minute. No, I'm going to take this amount we received divided by the total cash flow, and I hope I'm gonna pause and put the total cash flow here. Sorry about that. Okay, now I really should explain this better. Maybe this is why this Redcliffe got all pissed off at me. But this one, to do this, to do this after-tax business properly, I put the cash we received from the taxes in one account and just the cash we received from operations in another. Now the cash we received, and I also put a subtotal in in between the opening and closing balance, which there's nothing wrong with doing that. I was always afraid to do that. There's absolutely nothing wrong with it. So this time you can see how much you had left kind of in an adjusted opening balance and take the minimum. Oh, that's nice and clean. Oh, very good. And then we get to this minimum, which is like this cash sweep business, and this gives us exactly the right return. Oh, that's just beautiful to look. And this is exactly what I can't see doing this in another way. Now, the difficult part of this is this damn tax business. This could be negative, and we've got to make sure that as soon as we hit the opening balance being zero, we turn it off. Otherwise, it gets crazy a little bit. So that's one of the things. And then the other thing is, well, this is the investment tax credit. Otherwise, it's just kind of a regular old minimum account. It's the minimum of the why did I not we can stop it here. It actually should be the minimum of K65 plus the accrued amounts of cost of capital. So that hopefully won't make any difference at all. And it doesn't. So now let's kind of do it in a cooler way. If we put less, then we get a flip right here. We got a flip really early. If we put 1.3, we got a flip only in year 2. And what happened to this one? Oh no, I'm gonna leave that for now. Okay, I'm gonna put a flip here. I cheated just now. Okay. Or flip 4. So we get a flexible flip. And when we hit this flip period, here's what I did. I take the amount of cash we had here, which we should also make sure that that's not negative. This should have been hit the minimum, but I should have turned the cash around. Screw it. I'm going to leave it. You go through it if you're really working on all this stuff. That's really bad, but we should have put the cash taxes as a positive instead of a negative, and then the minimum wouldn't have got messed up like this. But this is the amount of cash we're receiving divided by the total cash. So in this period, and that's for me the other real trick in doing this, is to get the senior investor pre-flip, and then we have the sponsor pre-flip, and that's just they just get I'm not going to do it here, 1 minus this one, so they get 84 in this period. Now these are irrelevant, because then we put the I've got to stop again.